Hey everyone. I want to apologize. I've been having trouble recording with the normal way I do it with the videos, so I'm just having to record this one this way. So hopefully this is as exciting, if not a little less interactive. So in this lecture, I want to talk about whether or not the monetary system that we've been exploring in this unit creates a growth imperative in the general economy. What are some of the problems with the system that we've been exploring, and what are some of the alternatives that we can look at to minimize bank created money? So, first of all, I want to talk about this idea of money and entropy. And ecological economists, as you know, focus our work on this concept of entropy. And this came from some of the early thinkers of ecological economists, specifically a chemist by the name of Frederick Soddy. He was a Nobel laureate, and he was really concerned with this idea of how real wealth is entropic and obeys the laws of thermodynamics, and money does not. And that's really where a lot of the early work of ecological economics was focused. Now, Frederick Soddy argued that, like I said, real wealth, the things that we eat, the things that we own, our homes, our desks, our computers, this is real wealth. And this includes actual resources, right? The goods and services that we have that consume real wealth obey the laws of thermodynamics, right? So accordingly, real wealth can only grow according to physical laws. As we've said, one of those physical laws, the first law of thermodynamics, is that we cannot create something from nothing. We also cannot create nothing from something. That's the first law of thermodynamics. And the second argues that entropy always increases. So, this real wealth, the stuff that we have, what we can touch, the tangibility of our wealth, follows the laws of thermodynamics and specifically grows according to those laws. Whereas money, which is the claim on that real wealth, does not obey the laws of thermodynamics. And Frederick Soddy argued that unlike matter and energy, money can be created and destroyed. And we explored in this unit how money is created and destroyed in our economy. And the biggest argument that Frederick Soddy was making is that while real wealth can only grow according to physical laws, money can grow without interest via what we call compound interest. And compound interest is essentially if I take a £1 note and I invest it for 1 year at 5% interest, in 1 year I will have £1 5 pence. In a year, then, I can take that £1 5 pence and invest that whole amount at 5%. And I can keep growing my money supply, and that interest then keeps growing on prior interest earned on that initial principal. And that is compound interest. The interest compounds. And mathematically, this happens very quickly and creates a very vast amount of money very quickly from the compound interest of exponential growth. Now, what we see here is in the UK, in this chart here, the UK GDP and the UK money supply have sort of diverged from one another from about the early 1980s. Now, interestingly, in the early 1980s is when our financial system and our banking system globally became heavily deregulated. Right? I shouldn't say heavily deregulated, they just took a lot of the regulations away. And what we see is that our money supply began to outstrip the real wealth that is constituted by our GDP and how we measure the things in our economy. And we've argued as ecological economists that there is this entropic contradiction between money that cannot obey the laws of thermodynamics and the fact that what that money claims must obey the laws of thermodynamics. Now, that sort of lays the foundation for what I want to talk about in the rest of this discussion is that some of the problems with our modern monetary system. And one of the major problems that we want to highlight is that when a monetary system is focused on profits, it gives banks tremendous control over the shape of the economy and discriminates against activities such as education, clean energy, healthcare, and sustainable agriculture, because they don't necessarily return a profit, right? An educational system, clean energy, industry, healthcare can provide some profits, but they don't necessarily. And oftentimes they just provide a service, right? When our entire monetary system, or 97% of it, is a function of bank profit, there isn't money that's circulating in the economy for these things that don't make profit. And therefore, we see that this profit controls our economy. And as we sort of touched on earlier in this unit, our monetary system drives what has economic value in our system, and therefore things that have value are things that are profitable and not necessarily the things that we need, such as education and clean energy and healthcare and good food. So when we say how have banks been using the money that they've been created, this chart here shows from Positive Money down in London, which we're going to explore some of their policy alternatives in a moment, over the last or over this about 20-year period here, we see that that very bottom portion of dark blue is the business sector, general businesses getting loans, as we've been talking about. But the vast majority of new money in our economy has been created by UK banks for mortgages and secured loans, financial sector, and for commercial property. So we see this huge boom in this financial industry, which is even more removed from the things that we need, such as education, clean energy, and healthcare. And that's part of why we see these booms and busts in the mortgage market. We see asset price inflation and rental prices going up. We see a lot of problems when our monetary system is focused on profits and not really connected in a real way to our real economy. Now, I want to discuss three major problems with our system of bank money. From a social perspective, when we create money through interest-bearing debt, it transfers money and wealth systematically from borrowers and renters to lenders and landlords. So individuals like me who borrow money for my car or my home, or I rent my home, we pay money to those institutions who own those properties and create that money. So we're systematically transferring wealth from individuals like you and me into that financial sector. And the money supply necessarily decreases when loans are repaid. We're going to touch on this in just a moment in more depth. But when I pay back a loan to the bank, that means the total amount of money in circulation decreases when I pay back that loan. In order for that money supply to then get back to where it was, new debt needs to be taken on. So we see this system where the money supply is always being contracted by loans that are being repaid, and then always needs to be recreated by new loans, which has social implications, as I just mentioned. From an ecological perspective, debt needs to always grow, and we're going to touch on the discussion around that in just a moment. But when money is created as debt, it needs to always grow in order to cover the interest rates on that debt. And this puts an enormous strain on ecosystems, because while money that is decoupled from GDP can happen for a little bit, at a certain point, that money needs to claim actual resources in order to legitimize itself and realign itself with that real wealth, or else we'll see an economic bust. So what happens is these money supplies end up having to extract resources and create goods that can align that money supply with those underlying goods. And this is a little bit different, but similar to what we saw in 2008, that the money supply created for the housing market was not aligned with the value of the homes underlining that housing market. And that happened for a little while, but at a certain point, those had to come back together, and we saw the global financial industry completely collapse in 2008. More importantly, perhaps, however, is that profitable enterprises have to externalize ecological and social costs. And what this means is that in order for an enterprise to pay back the interest and their principal on the credit that they've taken out from the bank, they need to be profitable. And in order to be profitable, you need to minimize your costs. And costs are often minimized by decreasing labor or cutting corners on extractive activities and being less than environmentally sustainable. Now, that's not to say that industry and profit in business are all bad. No, there are very good, profitable businesses. But as a whole, when the entire economy needs to be profitable, we see this tendency to externalize ecological and social costs. And then from an economic perspective, economic value in our society, when our money is created this way, is a function of what banks find profitable, right? So we don't have economic value necessarily for sustainable agriculture or renewable sources of energy, but rather we see it for mortgages and extractive industry because those are highly profitable, right? So our economic value is a function of what banks find profitable. Importantly, though, in order to get more money in the economy, as I've touched on, people need to go into debt. And when people need to go into debt, it's again that systematic transfer of wealth, which can then cause these booms and busts, like I sort of mentioned a moment ago with respect to the housing crisis in 2008. Going back a little more in a little more detail, this economic system is really prone to booms and busts. If banks during a booming economy see that everyone is doing well, they're very happy to lend out money into the economy. That means that more people get money into the economy, which causes a bigger boom, which means banks are more prone to create money, and so on, in sort of a vicious cycle, or virtuous cycle since it's going up, or a positive feedback loop, as we might say. And banks can sort of exacerbate the boom. But then on the flip side, when a bust in the economy occurs, banks are reluctant to extend credit. And when banks are reluctant to extend credit, what happens is individuals who are borrowing money are paying back their loans. That's pulling money out of the economy, but banks aren't willing to extend credit to put money back into the economy. So we see this exacerbation of the bust and a positive feedback loop in the opposite direction. So kind of discussing going on from that whether or not when we spend money into the economy, there needs to be more paid back. Ecological economists have been very concerned with this question of the growth imperative. In other words, does our money system create an economy that must grow? And the argument has been used by Daly and Farley in the textbook. I've used it in some of my early work. It's pretty ubiquitous in our field. And the argument goes like this, and this was originally popularized by a woman named Margaret Kennedy in the 1980s, but it's generally been sort of a consensus in the economics community that banks create loans to individuals, right? We know this. Individuals then pay back that loan to the bank with interest. Now, for an individual, that's fine. If I'm this borrower, I can pay back my loan with some interest, and I can get that interest from one of you. I can sell some goods and services or whatnot. I can get that interest. But if you notice, the initial amount of money that was created did not create the interest. So from an economy-wide perspective, there is never enough money created in order to pay back the amount of money that is demanded back to the bank. And this is popularized here by this equation, P is less than P plus I, or principal is always less than principal plus interest. And the argument here then is that in order to pay off the interest in the economy, from an economy-wide perspective, the amount of money in circulation must always grow by at least the interest rate that prevails in the economy. Now, this, like I said, was sort of the consensus for quite some time. And then about 2014, 15, 16, a couple of ecological economists, or four rather, teamed up with some post-Keynesian economists to write this paper here, which was written by Louison Kai-Han-Fo and Marc Lavoie, and this paper here, which was written by Peter Victor and Tim Jackson. These are both in the supplemental readings on Minerva if you're interested. But these individuals said, okay, let's question this monetary growth imperative. What's going on here? And their findings were quite similar, though they took very different methodological approaches. But their findings were essentially that the interest that is paid back to banks isn't kept by banks, it's spent into the economy as wages to workers and to shareholders as profits and dividends, right? So while the money supply or the interest does indeed get paid and pulled from the economy and given to banks, that money goes right back into the economy in the form of wages, profits, and dividends. And because of that, it's important, these authors note, to differentiate between the stock of money and the flows of interest from that money. And they argue that the stock can be the same and can flow around the economy many times. Now, again, we've talked about stocks and flows quite a bit in this course because this concept is very important to ecological economists. We argue that the characteristics of stocks and flows are different and need to be understood differently. And these economists did exactly that by constructing what we call stock flow consistent models to understand that the money supply through credit is a stock and the interest that flows from that is a flow. And they make the argument that economic activity can be steady. We can have a steady state, non-growing economy that includes interest rates on debt money without the money supply creating new money to cover that interest. And again, because that interest is paid back into the economy, can circulate, can be paid back as interest, and keep circulating on a steady stock of money. Really, really, really good papers, really, really great ecological economists, really interesting findings. But they did nevertheless spark a debate in our field that Roman Schwartzman and some of his colleagues, to include myself, entered into in about 2020, and we started to say, okay, look, we know the argument about P is always less than P plus I. We're familiar with the arguments that these four individuals that I just made were arguing for. Now we want to add a little bit to that argument, and it's become known as what's called the growth imperative debate, and it is still ongoing within our field, and it's quite interesting. And these authors argued that the generalization of interest rates that emerged during the Middle Ages represents an historical shift that is intricately related to the establishment of capitalist socioeconomic systems whose main goals are to endlessly accumulate money. Now, what does that mean? Well, there's sort of three takeaways from that. We say that capitalism as an institution accumulates wealth. It's sort of definitionally, at least a part of what capitalism is a system that accumulates and hoards wealth by the owners of capital. The argument then is that because of that, interest will never be fully spent back into the economy. Yes, interest rates are paid through as wages and profits back into the economy, but capitalists and owners of banks do not ever fully pay back all the interest into the economy. And because of that, that interest does create a growth imperative, but a growth imperative exists because of the hoarding and accumulating nature of capitalism, not necessarily because of the interest rate. So we sort of make the argument that yes, from a technical perspective, the models can show that interest rates do not create a growth imperative, but nevertheless, there is a growth imperative in capitalism, importantly, that is characterized by money created through private debt. So we sort of complicate the issue. And we do so by drawing on institutionalist and anthropological literature. And the institutions that we argue that are creating this growth imperative are capitalism itself, the culture of capitalism that creates a tendency within our culture to accumulate wealth, and the institutional nature of money in our society as what we call a total social fact, drawing from an anthropologist named Marcel Mauss. Now, we also distinguish between the economic endogeneity of money, which is to say our money system is endogenous or comes from within the economy, And we say money is actually more than economically endogenous, it is socially endogenous. Our monetary system comes from within who we are as a human civilization, and money and the system of debits and credits that have gone back thousands of years are particular to who we are as human social beings, and that institution is critically important for creating this growth imperative. Now, responding to whether or not there is a growth imperative and some of the problems with bank-created money, there have been some calls in ecological economics to institute what's called full reserve banking. And this idea was popularized in the 1930s by Irving Fisher in response to the Great Depression. And what this proposal does is it argues that in order to stop banks from creating money, the government should require 100% reserves on banking deposits. So for every pound of deposits that I have, a bank needs to hold a pound of reserves. And because of the money multiplier that we discussed, the money multiplier in this system with 100% reserves would be 1. Remember, the money multiplier is the inverse of the reserve requirement, and the inverse of 1 is 1, which means the banking sector could only multiply the money supply by 1, which means it couldn't multiply the money supply at all. Others have argued, however, that as long as central banks act as the lender of last resort and savings and lending activities are not separated, banks can continue to create money. And the argument would go like this. If someone walked in and wanted a 100 trillion pound loan, the bank would create it out of thin air if it thought it was profitable to do so. Now, the bank would have to then get 100 trillion pounds in reserves, but as long as the central bank continued like they do now and promised to lend those reserves upon request, that loan would be made. Now, sure, this would definitely eat into their profits, and I haven't really discussed anything about capital adequacy ratios or balance sheet implications, but the point is that as long as the central bank acts as lender of last resort and savings and lending activities aren't separated, banks can still create money. And the argument here generally is that since, as we discussed in the last lecture in this unit, if a fractional reserve system does not exist, then a full reserve system does not address the problems of commercial money creation. And as I argue here in a 2019 paper, I say it is not the reserve requirement that limits money creation. It's the separation of banking activities and the requirement that savers and borrowers cannot use the same money at the same time. So this idea that we need to limit a bank's ability to create money by separating savings from deposits, not necessarily by increasing reserve requirements. Now, I should also add in here, there has been a lot of really good work and thinking around full reserve banking in the field of ecological economics that we as a field have learned from and gained from, and I'm not trying to say these people are wrong. We just as a field continue to grow with our understanding of how our monetary system works. And some of that learning has been gained from a group called Positive Money down in London, who's done some phenomenal work advocating for what they call a sovereign money system. And in a sovereign money system, a national public bank creates money by spending it directly into the economy. Now, this would go through a government apparatus or something, surely, but for the sake of this picture, it's easier to show a national bank spending money directly into the economy, or continuing to lend into the economy, right? We can spend for public works projects and bridges and roads and healthcare and education and sustainable renewable resources and all these types of things, but then individuals are still going to want credit. We've needed credit to run our businesses for the last 5,000 years, as we explored in this unit. So we still want a lending arm in our economy, and the National Bank could handle that. They could lend to regional public banks, who would then on-lend to individuals in the economy. Now, the specific sovereign money proposal includes commercial banks in this regional public bank role that in the paper here that I discussed, that I have in review, I've replaced with publicly owned, full nationalized banking system. The dynamics aren't that different. It just depends on whether or not we have commercial banks or public banks. But again, they're on-lending that money. And money is removed from the economy by interest on those loans, and then also through taxes on things like income inequality and environmental bads and pollutions and things like that. And then our payment system still works as it does today, or from your perspective it would, whereas if you have money in a savings account, you can spend it into the economy, and then that economy then takes that money and saves it through deposits with those regional public banks. And we see this circular system here as this payment system that is completely separated. This payment system is completely separated from this spending and lending arm over here, specifically this lending arm. So as we can see, the lending and spending roles in our economy have been completely separated, whereas in the system we have here currently, they are intricately tied together. And you can also notice that in this system there are no reserves, because there are no reserves required in order to maintain stability in that overnight spending market, because that money is always there. And this system then allows us to, as we said earlier, direct value in the economy. If money is the foundation of value, then this system would allow us to spend and lend money into the economy for things that are sustainable, for things we need, like healthcare and education and good food and sustainable sources of energy production and equitable access to internet and transportation and things like this. And all of a sudden we can create money for those and therefore give rise to value for those things. We can also discriminate in our money creation and money destruction policies against things like fossil fuels and housing speculation and things like that. So all of a sudden our money creation system and our money destruction system can influence what has value in our economy. So I hope this was enjoyable for you. Really think about what are some of the problems with our monetary system that you see, and then what are some of the solutions that you might have in your mind that might be different from what we've discussed here. There are a lot out there, and I'd love to hear your thoughts. Thanks so much.